Hello, everybody. It's high noon on Wednesday. It's time for our last webinar in our series of webinars. So we are pleased about that. We can get ready to get focused on upcoming busy season. My name is Rob Trammell. You probably saw my bio and I did an earlier presentation. So I'll just give you a little bit of background about myself. I have been a tax partner here at Abbott, Stringham & Lynch since 1998. Much like my other partners, I specialize in closely held companies and the owners. Our firm, Abbott, Stringham & Lynch, has been around for over 40 years. We service a variety of different industries and clients. You can gather more information about our website, and as I said, as this is the sixth webinar in our series of webinars, I'm sure you've heard a lot of information about our firm. Before I get started on the actual content of today's webinar, I just have a couple housekeeping items. If you'll notice up in the right-hand corner of your screen, you'll see that there's a Q&A feature. So if you have questions as I go through the presentation, please go ahead and type those in. I will try to get to some questions at the end of the presentation. Of course, it depends on how long the presentation takes, but I expect to have time for a few questions at least. You can print the slides or you can save them to reference at a later point. There's a multimedia button also up in the top right-hand corner of your screen. So if you click on that, it brings up the presentation and you can either print it or save it. Unfortunately, we don't offer continuing education credit for these webinars, so you'll have to get your continuing education elsewhere. If you need to leave early, or you want to share this presentation with a colleague or a friend, all of our webinars will be posted to our YouTube channel. It'll take a couple days to get this one up there. The others in our series, I think, are already up there. So you can go back and review them at your leisure. I'm sure you'll find this very scintillating and you'll want to review it quite often. And then finally, the final housekeeping item is there will be a survey at the end of the webinar where you can give your information if you'd like us to follow up with you. And then, of course, to give us your feedback as to how we could have done better or whether there was some additional information that you would have liked to hear. One more thing before I dive in is, as this is the final webinar presentation, I'd like to give a big thank you to all of the people internally who have helped put all of these webinars together. It's quite an effort. I am, and my other presenters are the fortunate beneficiaries of all of those people's efforts, as we just get to come in here and talk about something that we find interesting. But from our administrative people to our marketing people to our IT people, we couldn't have done any of these webinars without them. They make sure that it all works when we come sit down and get ready to talk. So a big kudos and a big thank you to them. Like I said, we couldn't have done this without them. So without further ado, let's go ahead and get started. What I'm going to talk about today in this hour-long webinar is the tax reform for pass-through entities. So this most recent tax bill, as you've heard some of us discuss, is, at least for me personally, is the largest tax bill that I've ever seen in the history of in my career. I graduated from Santa Barbara in 1990, and so I learned the 1986 tax law. And along the years, there have been small tweaks and changes and little things here and there, but nothing as comprehensive as what we've seen in this newest tax legislation. And while it's quite exciting, we think that it creates a lot of opportunities. It's also a little bit overwhelming in that we're learning along with all the rest of you about what the implications are. You'll also hear me talk as we go through this that because the law is so new, we're waiting for guidance in a lot of areas. And this particular area, we're hoping, the IRS has actually come out recently and said that this might be one of the first areas that they issue guidance on. And so we're hoping to see some additional guidance from the service. The law is fairly nebulous in certain areas, and we need some clarification to help us interpret what the law is. So the agenda for today is we're going to talk about qualified, basically the topic is qualified business income deduction, or QBI. You'll also hear it referred to as the pass-through deduction. So we're going to talk about what that is. We're going to talk about what type of qualified business income is and what it is not. In other words, what income might you have that could qualify for the deduction? We're going to talk about some income phase-out ranges. We're going to talk about specified service businesses. And then we're going to take a minute, once we have kind of the concept about how this works, we're going to take a minute to talk about some planning opportunities that we want our clients or other individuals listening, we want you to think about. There's some situations where you might not be able to avail yourself of this deduction. However, if you changed your entity type or made some changes, perhaps you could get some benefit. And then the last item we're going to touch on is, as many of you know, one of the big changes in this tax law was a flat 21% corporate tax rate for C corporations. So one of the questions that we're getting a lot is, should I switch my pass-through entity, LLC or S corporation, to a C corporation to take advantage of the potentially lower 21% rate? So we'll spend a minute on going through kind of the effective tax rates as it relates to those two different types of entities. All right, let's dive right in. So we have a new code section, Code Section 199A, also known as the Qualified Business Income Deduction. It starts effective 1/1/2018 and expires at the end of 2025. So you've got 8 years of this, pending a change in the political structure, and if they were to change the law, they could always do that, but we've got it at least for 3 years, and it's written in the law until 2025. What it does, in a nutshell, at the highest level, is it gives owners of pass-through businesses a deduction equal to 20% of their qualified business income. So that's it. If you have an S corporation or an LLC, and you make $1 million in income, you get to take 20%, deduct $200,000, so you pay tax on $800,000, right? End of story, webinar over. As usual in the tax law, they give it and they take it away. So we're going to talk about some limitations that will apply. It's always not as easy as it seems, but conceptually, that's where we start. If you have a pass-through entity, potentially you could qualify for a 20% deduction on your tax return, a 20% deduction against that qualified business income. So who gets it? Who actually gets to potentially take advantage of this deduction? We've already had a number of questions about, do I need to take my sole proprietorship and incorporate it into an S corporation or put it into an LLC? Another similar question is, I have a bunch of rental real estate properties, and I've read that those might be able to qualify. Is that true? Who qualifies? Sole proprietorships do qualify. So if you're a sole proprietor, basically you report your income and expenses on your individual return on a Schedule C. Sole proprietorship is the simplest form of operating a business. And so you can qualify as a sole proprietorship. Real estate investors, we believe real estate investors qualify. There is a requirement in the law that in order to qualify, you have to have an active trade or business. So then we get to, well, when do you have an active trade or business? It probably depends on facts and circumstances. The famous answer for tax people is, well, it depends. And it depends on your facts and circumstances. How much are you involved? Are you really just a passive investor who sits back and has a management company and collects rent and you don't really have much active involvement? Does that mean that you don't qualify? We're not sure, actually. We believe you would qualify, but that's an area that we're waiting for some guidance from the service in. Interestingly enough, when the proposal first came out I think it came out in the Senate version first, or the House version first, but we didn't think that it was going to work for real estate investors, but they needed the vote of a particular senator, Bob Corker, who apparently he made his income through real estate. So You may hear this referred to as the Corker Law or the Corker Rule. Of course, our President Donald Trump also benefited by the fact that if you own rental real estate, you're going to qualify for this deduction. There is a little caveat to real estate investors, and we'll go through that as we talk about the requirements. But sole proprietorships, real estate investors, S corporations, which we deal with a lot of here, partnerships, including LLCs, of course, disregarded entities. So some of you are familiar with single-member LLCs. Single-member LLCs are quite popular as a entity to hold real estate. They are a legal entity, so they can provide you with legal protection, while for tax purposes, they're effectively disregarded. So you get some legal protection with a fairly simplified tax filing process. The deduction, the 20% deduction, can also qualify for trusts and estates, REITs, and qualified cooperatives, although we're not going to spend much time in that particular area. So the answer to the question is no, you are not required to set up an entity, corporation, S corporation, or a partnership to qualify for the deduction. However, again, you may want to. So we'll look at some particular facts and circumstances under which you may want to consider putting your assets into an entity. All right, so we've talked about the general concept. Now, what is qualified business income? So qualified business income is all domestic business income. So if you have income that flows through from offshore, that does not qualify. That is not eligible for the 20% deduction. So we'll have to bifurcate between domestic income and foreign income in the event that we have that situation. And it does not include investment income. So you don't include interest, dividends, and capital gains. It also does not include C corporation dividend income. So if you are a shareholder in a C corporation and you receive some dividend income, that's not included in the qualified business income. Reasonable compensation to an S corporation owner or employee. So that's an interesting one, and it follows the same logic as guaranteed payments for services in partnerships or LLCs. So guaranteed payments in partnerships or LLCs are exactly that, where you get a guaranteed amount per month that's not based on the profit or loss of the business. For me, because I work with more corporations, the area that I'm more familiar with is related to S corporations. So what they're saying there is, let's say you have, again, an S corporation that nets $1 million, and that flows through to your individual tax return. You would get, assuming that you qualify, you would get a 20% deduction against that $1 million of income. So you would pay tax on $800,000, right? Well, then the IRS comes in, and as regards S corporations, we've always had this issue of reasonable compensation, because the IRS says if you are an employee of your S corporation, you should pay yourself reasonable compensation. But there's an incentive to pay yourself a lower amount of compensation, assuming that you're the sole shareholder or one of a few shareholders, because you don't have to pay the associated payroll taxes. Well, the IRS is wise to that scheme, and for a number of years has been auditing S corporations without any officer compensation. With this new deduction, however, if you think about it, you are incentivized to keep your compensation lower. So this encourages you to keep your compensation lower. Let's go back to my example where you have an S corporation that has $1 million of net income, and you're currently not paying yourself any salary as the owner. $200,000 deduction, you pay tax on $800,000. Now let's say you pay yourself $500,000 of compensation. So all of a sudden, you've got $500,000 deduction on the S corporation, so the net income from the S corporation, or your pass-through income, is $500,000. On your individual tax return, your income, total income, is the same, because you have $500,000 from the W-2 that you just got from your S corporation, and you have $500,000 from your S corporation net income that flows through to your individual tax return. So the same $1 million on your individual tax return. However, the pass-through deduction now is 20% of $500,000 or $100,000. So you just took a haircut there. So we still have that balancing act between reasonable compensation and S corporations, but the incentive to keep your salary down in your S corporation is still there because of this deduction. All right. Where is the deduction claimed? Well, it doesn't affect the business tax returns at all. You're still going to do the entity tax returns, the sole proprietorship, Schedule C's on your individual tax return. You're still going to do those the same. The deduction is calculated on an individual's personal tax return. It's a below-the-line deduction, meaning you start with total income, you make some adjustments, you get to adjusted gross income, and then from there you take this deduction for 199A, the qualified business income. You can take it whether you itemize or not, and the deduction does not apply to self-employment tax. So if you have a Schedule C or a partnership and you have self-employment income, you pay self-employment tax on that income. That's basically the payroll taxes, the FICA and Medicare, of which you pay both sides. And this deduction does not reduce the income that's subject to self-employment tax. Okay? All right, so now we understand where it goes, and now we understand, hopefully, who it applies to, when it applies, and how much the deduction is. Now, let's talk about some limitations. So there are income phase-out ranges. So in the event that, I'll try to, it gets complicated. I'll try to break it down in pieces. So there are income phase-out ranges. As you can see, married filing joint, 350. The phase-out starts at 315,000, and it completely phases out at 415,000. Individuals are half of that. So individuals and all other filing statuses, actually. So individual, single head of household, married filing separate. Those filing statuses are exactly half of that. So 157.5 and then 207.5. There's a $50,000 range there, and at married filing joint, the range is $100,000. So, great, Rob, you just told me that the deduction is 20% of my qualified business income, but now you're telling me there's some limitations. That's true. So if you are subject to these limitations, which probably most of our clients or most individuals who have these flow-through entities are, there are some additional considerations that you have to make. The first one is whether you are in a specified service business, okay? If you're not in a specified service business, we're going to call it another kind of business, but basically a specified service business is bad, and any other kind of business is good. And by bad, I mean no deduction, and by good, I mean probably some sort of deduction. So now we've got the 20%, we've got some phase-out ranges. Well, let's take a look at the next considerations is if you're in those phase-out ranges. So suffice it to say, if you don't meet the phase-out ranges, you qualify. You get the deduction, okay? You don't have to go any further. If you are within those phase-out ranges or above those phase-out ranges, you need to do some additional consideration. And so the first is related to specified service businesses. So the IRS, the law basically singles out certain types of professions and says in the event that you are within those phase-out ranges and you are in these specified service businesses, you get no deduction, okay? In the phase-out range, specified service business, no deduction. So what is a specified service business? Well, a specified service business is traditional services such as us, accountants, physicians, attorneys, actuaries, and consultants. These are kind of similar to the old personal service corporations where you had C corporations had graduated tax rates, but the IRS said, well, if you just set up a corporation because you want to get the benefit of the graduated tax rates and get some deductions against that income, but you are basically a personal service, meaning all of the revenue that you generate is based on your knowledge. They taxed you at 35%. So this is kind of a similar way of thinking. But they call out these service businesses. It includes performing artists, paid athletes, financial advisors, anyone who works in the brokerage industry, and then kind of the catch-all. And again, this is the area that we're going to need some additional guidance. The service has come out and said that they're hoping to issue guidance. I'm not so sure how fast that'll come. The IRS these days, their budget keeps getting held relatively low, so I'm not sure what their assets, what their resources are, but we're hopeful that guidance will come out. But this is kind of the catch-all. Any trade or business where the principal asset is the reputation or skill of the owner. So, if we don't get guidance, we're going to have to make a determination when we file the 2018 tax returns. The IRS interprets the law through regulations and other ways that they publish findings, or the way that they interpret the law. And oftentimes, if taxpayers disagree, you end up at court. So this may be an area that we just have to eventually rely on litigation and the court cases, but we'll see. Like I said, hopefully there's going to be some guidance. So of note, not included in the traditional service professions are engineers and architects. So they must have had good lobbies, but it seems like they would kind of be included in the catch-all anyway. So we'll have to see what the IRS guidance comes out with. Okay, continuing on. So then, well, what happens if you're not in a specified service business? Well, then there's some other limitations. So once you reach the threshold amount, then we have to consider some other limitations. So once you reach the phase-out levels, we have to consider some other limitations. So again, that top bullet point is pretty important because the specified service business doesn't matter unless your income exceeds the threshold. When you're in between the threshold, so let's say that you're in between the 315 and the 415 for married filing joint, even if you are in a specified service business, you still get a partial deduction. If you're below the 315 for married filing joint, you get the full 20%. So that's the way that works. For all other businesses that exceed the phase-out level, you have to go to another calculation. So that deduction is limited to the greater of 50% of the wages with respect to the qualified trader business, so the wages that the entity pays, or the sum of 25% of the wages with respect to qualified trader business, plus 2.5% of the unadjusted basis immediately after acquisition of all qualified property. So that last one, the 2.5% of the unadjusted basis of property, of qualified property, that's where the real estate investors get a bang for their buck. Because if you think about it, if you own real estate and you qualify, you're probably not paying W-2 wages, particularly if you're reporting it on the Schedule E. So you'll get some deduction, but it's going to be based on that 2.5% of the unadjusted basis. And we'll run through some calculations, which will hopefully make all of this clear. And so I think, let's go actually to the next slide, and we'll actually start on some examples. So we kind of have the groundwork laid at this point for what income qualifies, what type of entities qualify for the deduction. We've talked about the phase-out ranges. We've talked about specified service businesses. And then we've talked about the additional calculations that if you're not in a specified service business, that you have to go through to figure out the amount of your deduction on your individual tax return. So here are some examples that will kind of run through all of those different scenarios. So example number one, Thomas is single and he earns $100,000 in a law firm that he operates as a sole proprietorship. His taxable income is $100,000, So he gets to use the full 199A deduction of $20,000. Even though he's in a specified service business, he's under that phase-out amount of 157.5. So because he's under that phase-out amount, he gets the entire $20,000. So he's good. Example number 2, Martha is also single. She's married. Sorry about that. Martha is married. She earns $500,000 as a surgeon working as a partner in a surgical center, and her family's income is the $500,000, basically the money that she makes as the partner. So she is over the $415,000 phase-out amount for married filing joint. Okay, but she's also in a specified service business, and so she gets no deduction. Okay? Let's grab some water. Now let's go to the third example where we've got a calculation. So Nancy is single, and she is the sole shareholder in an S corporation. Her S corporation pays her $100,000 in W-2 wages, and she earns $400,000 in net qualified business income. So she's over the she's over the 2075 as single. She's not in a specified service business, so then we have to go to the next limitations, the higher of the two limitations that apply. And those limitations are 50% of her W-2 wages. So we can see that her W-2 wages are $100,000. Presumably that's what she pays herself. And then you compare that to the 25% of wages, which is obviously less than 50%, and the 2.5% of the unadjusted basis of property. And so 50% of her W-2 wages, or $50,000, is higher in that calculation, and so she gets a 199A or pass-through deduction of $50,000. Okay? Just kind of calling out the next page. Of course, in the prior example, if she operated a specified service, trade, or business instead, she would get no deduction, again, because she exceeds the limit of 207,500, and she's in one of the specified service businesses. Let's look at example number 5, and this talks about a real estate investor, and we'll get into the asset calculation and the W-2 calculation. So Sarah is a real estate investor who has net rental income of $500,000 on her Schedule E. So she has presumably a number of rental properties, and those kick off net rental income of $500,000. She does not pay any wages, and her unadjusted basis in those properties is $800,000, which is basically the purchase price. So here's the calculation. She's over the limit, and so you look at the 20% times the $500,000 is $100,000. That would be the straight calculation at 20% of her net income. However, because she's over the limit, then you have to go to the two other calculations, and you get the higher of the two other calculations. The first is the 50% of W-2 wages, and in our example, her W-2 wages, and it's not just her W-2 wages, it's W-2 wages that the entity pays. She's not paying anybody any W-2 wages, so W-2 wages are 0. Obviously, 50% of 0 is 0. And so then you're left with the second calculation, which is 25% of the W-2 wages, which we didn't include, but that's obviously 0, plus 2.5% of the unadjusted basis of the property, which is $800,000. So 2.5% times $800,000 is $20,000. So Sarah's deduction on her individual tax return is $20,000. Okay, so that's where we kind of get into the limitations based on the fact that she exceeded the phase-out amounts, and then also that we have to look at the wage calculation and the unadjusted basis of property calculation. Okay, Example number 6 is an example of a partial deduction. I'm not going to spend a lot of time on this particular example. You can read through it at your leisure, or if you're interested. But basically, the point of this example number 6 is you've got somebody with income who's between the phase-out ranges, and it's really just a percentage of how much you exceed the lower bracket of the phase-out range. So you can, and then your deduction is limited based on that percentage. So you can run through that example. If you qualify for the pass-through deduction, it's important to remember that it's really just that. It's a deduction. And so to try to get an estimate of what your tax benefit will be, you would obviously take that and multiply the deduction amount by your marginal or top tax rate. And remember, the deduction will come off the top, so it reduces your highest tax brackets first. As I'm sure you've heard if you've listened to these webinars or are aware, there are now 7 individual tax brackets. So it comes off the top in the calculation of your taxable income. So, if you have a $200,000 deduction, back to my $1 million of SCorp income example, and you have a $200,000 deduction, if you're in the 37% bracket, it saves you $74,000. So just keep in mind that you need to tax affect the deduction. Okay, so we've kind of gone through where we start, who qualifies. We've gone through the nitty-gritty of the calculations, provided some examples of how much the deduction might be in certain businesses. And then, so what I want to focus on now is I want to talk about particular situations where it might be good, based on what the rules are for calculating the deduction, to consider changing the type of entity or changing how you operate your business. So let's go through an example. So assume that you're a high earner, so you make over the phase-out limits. You're not in a specified service business, so you will presumably, potentially, could get some sort of deduction, but you need to go through the 2 additional calculations. You currently file as a Schedule C or a single-member LLC, and you file a Schedule C as a sole proprietor, but basically all of that income, the income and expenses, are reported on your individual tax return. You have no payroll or depreciable property. So what happens there is, if you think about it, you're over the phase-out income limits. So you have to then go to the next calculation of how much you're entitled to deduct, and that next calculation is based on 50% of your wages, or 25% of your wages, and 2.5% of the adjusted basis of your property. Well, in this example, you have no wages and you have no property, and so potentially you get no deduction. On the next slide, we show exactly that, but we put some numbers to that concept. And so in the example, you've got $370,000 in taxable income, $400,000 of qualified business income, no wages or property. In that case, your Section 199A deduction is 0, because as I just mentioned, you're above the phase-out limit, so you go to the next calculation of the potential deduction. You've got no wages and no property, so your deduction is 0. Now, if you flipped it around, if you created an S corporation and the situation is exactly the same, but all you did is, in the S corporation, you paid yourself as the owner $100,000 of salary, here's the results. So the first step is you take the lesser of 20% of the $300,000, and the $300,000 just simply comes from the $400,000 in the example minus the $100,000 of wages that you've paid yourself. So your qualified business income is that 300 grand. Remember, when we first started, we talked about reasonable compensation in an S corporation. So you're going to have to pay yourself something if you avail yourself of this strategy. But the qualified business income in our example is $300,000, so 20% of that is $60,000. But then you have to look to, because you're over the phase-out amount, the other limitations, which are 50% of your S Corp's total wages of $100,000, which is $50,000, or 25% of wages, 2.5% of the adjusted basis of your property, which is going to be less. So in that example, you get a deduction of $50,000. So if you tax affect that $50,000 deduction and assume that you're in the 35% tax bracket, it saves you $17,500 per year. Pretty nice. You'll notice at the bottom of this slide, I give credit to the Bradford Tax Institute. They put on a lot of good CPE for tax professionals, and so I got permission to use their slide, but I wanted to give them credit for the slide. So you can see, again, the $17,500 tax savings per year, presumably from 2018 to 2025. So you multiply 17.5 times 8, and that's a pretty good result. That, however, is not the end of the story. And so let's go to, it's obviously the situation where you're a high earner and you have those limitations. That you want to get some compensation out to you so that you qualify for the deduction, because the limitation is based on compensation, right? 50% of compensation. But what if you're even, under that limit? You're not a high income earner. So we often talk about, the appropriate situations to switch potentially from a sole proprietorship to an S corporation. So this is an example that runs through that, and it got more attractive with the benefit of this pass-through income deduction. So let's run through a sole proprietorship on the right-hand side of this slide. Sole proprietorship, so you've got net income after expenses of $120,000. It's just you, and so your wages are zero. So your qualified business income is $120,000. You are under the phase-out range, so no matter what business you're in, you could be an attorney or you could be me, a CPA, you're going to get the deduction. So the 199A deduction is 20% of the $120,000 or $24,000. We're assuming that your marginal tax rate is 24%. So the benefit that you get from the 199A deduction is $5,760. If we keep going in that same column, because you're a sole proprietor, I mentioned earlier that you pay self-employment tax based on whatever your net income is. And if you're paying self-employment tax, you probably understand what it is, but you're paying both sides of the Social Security and Medicare. If you work for a company, like I work for Abbott, String & Lynch, I pay my share of Social Security and Medicare, and then my employer, ASL, matches the other half. Well, when you're self-employed, you pay it all. So it's 15.3%. There's an adjustment for 7.65%. So the effective rate of tax on that self-employment income is 14.13%. So when you're a sole proprietor, if you had net income of $120,000, you would pay $16,956 in self-employment tax. And you're going to pay that each year. The 199A deduction doesn't impact that at all. Now let's take a look at the other column that is the S corporation column. And you've still got the same net income of $120,000, but you decide that you're gonna pay yourself wages of $50,000. So what you've done is you've brought your qualified business income that will qualify for the pass-through deduction down to $70,000. 70,000 times 20% is 14 grand. we're going to have the same marginal tax rate of 24%, so the 199A deduction saved you $3,360. Less than what the sole proprietorship saved you, but that's not the end of the story. So when you pay yourself as an employee, you have to pick up the payroll taxes as well. However, the cost is less because you're paying yourself, you're paying the payroll taxes on the amount that you paid out as W-2 wages. So the entire amount, the $120,000, is not subject to payroll taxes or self-employment tax. Only the $50,000 is subject to payroll taxes through the S corporation. So you can see the calculation of your costs there. We've included a little bit of unemployment. And so your payroll taxes through the S corporation are $8,150. So when we compare the cost of the payroll taxes from the sole proprietorship of $16,956 to the cost of the payroll taxes from the S corporation of $8,150, the savings on the employment taxes is $8,806. When you add the $8,806 to the $3,360, your total tax savings in an S corporation is $12,166, whereas in the sole proprietorship you only got the benefit of the pass-through deduction, and that benefit is $5,760. So, at least in this scenario, the winner appears to be an S corporation. Now, granted, there are costs to incorporating. So, you know, you're going to have the fees associated with incorporation. You're going to have potentially the cost of having somebody prepare your corporate tax return. You're going to have payroll, so, you know, that's a little bit of a hassle, and maybe you have a payroll company. But, you know, if you extend this out over a number of years, that $6,406 over 8 years starts looking like 50 grand or so. So, you know, that potentially could be quite a benefit. So just something to think about. If you have a sole proprietorship and it's just you and you don't have wages, you know, you need to think about potentially the benefit of switching over to an S corporation to get benefit of the pass-through deduction and maybe saving some payroll taxes. So that's a conversation that, if you haven't had it, it probably needs to be kick-started and take a look at what the benefits potentially could be. Okay. Then I thought it just might be helpful to try to pull it all together. I've actually seen a number of different flowcharts like this. I was last night getting ready for this, listening to a webinar, and the flowchart was so convoluted that it was just all over the place. So this is relatively simple. Like I said, there are a number of flowcharts out there. As we get exposure to some better flowcharts, I'm sure we'll get those posted to our website. But this comes from Spidel, which they're another provider of quality education for tax professionals. But does the taxpayer have business income? If the answer is no, you stop. It doesn't matter. If the answer is yes, is the overall business income positive? Because you take an aggregate, if you have a couple of different businesses and each of those, you know, the overall aggregate of those businesses is a loss, then it won't matter. You won't qualify for the deduction. If the business is positive, business income is positive, then the next thing you need to consider is the phase-out range. So if your taxable income is below the top of the phase-out range, you're going to get some sort of deduction. If it's not below the top of the phase-out range, then you continue on. So then you look at, if it's over the top of the phase-out range, then you have to look at whether it's a qualified or a specified service business. If you're over the top of the phase-out range and it is a specified service business, you're going to get no deduction. If it's not a specified service business, then more than likely you're going to get some sort of deduction, but you just need to run through the additional calculations that we've talked about a number of times. 50% of wages and 25% of 50% of wages, or 25% of wages and 2.5% of the unadjusted basis of the property. Okay. And then I just wanted to conclude the presentation, at least the slide portion of the presentation, with this chart here, which again comes from the Bradford Tax Institute. In the previous seminar that I did where we talked about business entities and the tax impact, both Luis Ramirez and I presented that one. We talked a lot about the new CCorp tax rate, the 21% tax rate. And we talked about whether, if you have an S corporation or an LLC, should you consider switching to a C corporation to be able to take advantage of the new 21% corporate tax rate? It's not a simple question. So let me explain to you what's going on in this slide. First of all, you need to understand that the assumption is that you're going to get the money out of your S Corp and your C Corp, no matter which type of entity that you're in. So back to my original example where you've got an S corporation that's making $1 million. You're gonna pull that money out. You're gonna pay tax on it, and then you're gonna pull that money out. C corporation, same idea. You've got a C corporation with $1 million of taxable income. You're going to pay tax at your 21%, and then you're going to take the difference, whatever the residual is, out. So that's what this chart does. It compares the effective tax rates of an S corporation with a C corporation, assuming that you take the profit out. Let's look at the 35% line. So in the S Corp column, what you've got are the individual tax brackets, right? So in 2018, you've got 7 individual tax brackets, and you can see those there. So if you look at the 35% tax bracket, if you have $1 million of income, you're going to pay 35% tax well, you'd probably be in the 37% bracket, but so maybe my numbers aren't a good example, but I guess the logic still works. You pay 35%, so you pay that amount. The rest is left in the corporation. Because the S corporation is a flow-through entity and it's taxed at the individual level for federal purposes, whatever's left over after you pay your individual tax, that's your money. So there's no second level of tax. So you have a rate of 35% on that income. If you had that $1 million inside the C corporation, there's a couple of different gyrations that you have to go through to get to your effective tax rate. So at the C corp level, you're going to pay 21%. Doesn't matter if your income is $1 or $10 million, you're going to pay 21%. Then, after you've paid the 21%, you're going to kick that money out to you individually because you want, let's assume that you want to have the money out. And so you kick it out to you. It comes out to you as a capital gain or a dividend. So that rate is 15%, at least in the 35% bracket column. That rate is 15%. However, you've already paid 21%, so the effective percentage when you take 79% of that is 11.85%. And in addition to that, we still have the net investment income tax, which was basically used to, it's basically additional Medicare that's used to pay for the Affordable Care Act. There was talk that the net investment income tax was going to go away. And so that didn't happen, so the net investment income tax is still with us. So you've got to pay 3.8% of whatever you take out as a dividend from the C Corp earnings. So again, that tax-affected amount is 3.002%. So if you take, when you're all done getting the money out to you from the C Corporation, you've got the 21% that you paid at the corporate level, then you've got 21% plus 11.85, which is the dividend tax that you paid on it, qualified dividend tax that you paid on it. And then you've got the 3.002, which is the net investment income tax. So your total effective rate is 35.85%. If you look at all of those columns, those first 2 columns, you can see that under any scenario, under any tax bracket, the S corporation with a single level of tax is potentially still better than the C corporation. Now, this is, again, using the assumption that you're going to take all the money, all the earnings out of the C corporation at the end of the day and get that to you personally. I'm sure there are situations where you're going to leave money, you may leave money in the C corporation because expansion, or you're going to buy equipment, or a variety of reasons. But suffice it to say that there was some talk that S corporations, LLCs, because of the 21% rate, would become much less popular. We don't think that's going to happen. I'm sure as each person in these webinars has been talking, with the new tax bracket, the new tax changes, every scenario probably needs to be talked about and thought about. It depends on what your exit strategy is for your company, what the future holds, what your plans are. So, it's not as easy as it used to be with all these additional deductions and tax rate impact and all that good stuff. So that's the last of the slides. Let me see what we've got. It looks like we've got a couple questions. Let's see. Okay, so the first question is, what is the reasonable compensation for an owner? That's a great question. Nowhere in the code is reasonable compensation for an owner defined, and there are a lot of court cases related to reasonable compensation that address reasonable compensation. The game was always, if you were the sole owner of a C corporation, and you were going to take the money out, generally you didn't want to pay corporate level tax, and so you would have your salary be basically what the profit was to try to pull the corporate income down. If you switched to an S corporation, the incentive was, because you didn't want to pay too high of payroll taxes and flow-through income was not subject to payroll taxes, you tried to keep your salary as low as you could. So we saw audits on both sides. We saw audits of extremely profitable C corporations where the owners were taking out, millions of dollars to try to reduce their corporate tax. On the other side, we saw audits of S corporations where the owners would try to keep their salaries artificially low. So there's both types of cases out there. I don't think this law will change that at all. There's no real answer for what is reasonable compensation for an owner. It's facts and circumstances. How much would you have to hire? The court cases look at the situation. How much would you have to pay somebody to come in and do your job? In a C corporation, what's a reasonable return on investment? If you were an investor in that corporation and your profit was $2 million, probably an investor wouldn't expect that you would take out as the owner the entire $2 million. So what's a reasonable expected return on investment? But they're all over the place, so I don't really have an answer to that. Let's see. Is the 50% of the owner's W-2 or total W-2 paid for the company? Yeah, that's a really good question. It's total compensation paid for the company. So in the calculation of wages, it includes employees and owners. So, you just get to take the wages that you paid out that's reported on your corporate tax return, on the S corporate tax return, or on your Schedule C. If you're sole proprietorship and you have employees, you're paying employees, you're not paying yourself. Similar concept for a partnership or an LLC. You can be paying employees, but you're not paying yourself. So you take that as the 50%. Now, these limits apply at the individual level, so that's something that I didn't mention. But let's say that there's two shareholders, myself and somebody else, and we have $1 million of wages. Well, I take under consideration 50% of my half of the wages. So I get $500,000 of the wages, and my other shareholder, the other shareholder gets the other half of the wages. So the limitation applies at the individual level on your share of how much the wages are. Let me see. Let's see, there's another question. Will you be sending out the slides? And the answer to that is we won't send them out, but again, at the beginning I mentioned you can go up to the top right-hand corner under multimedia, click. It'll have the slides. You can print those out or download them to your computer. Let's see. Another question, the income phase out is complete phase out, question mark? No. So the income phase out is not a complete phase out unless you're in a specified service business. So once you exceed those phase out limits, if you are in a specified service business, you stop the calculation. You get no benefit. If you are not in a specified service business, even if you exceed those phase-out limits, potentially you still get some benefit in that you then go to the additional calculation based on wages and unadjusted basis of the property. So if you go back to the slides, I think you'll see that there's a couple calculations in there. Let's see. There's a couple questions in here that talk about specified service businesses. Is a business a specified service business if it is a consulting training business where the owner performs some of the work and some is done by outside contractors? Really good question. I guess I would fall back to the definition that I mentioned earlier about personal service corporations. There's definitions in the code in a couple different sections about what a personal service business is, and they get to how much the owners contribute to the revenue of the company. I forget the exact definitions, but if it's one or two employees contribute to 90% of the revenue of the company or something like that, then I think you could have a problem. I think if it's a consulting training business where the owner does some of the work, but a majority of it is done by outside contractors, I think you're probably okay. Again, this is an area that we hope to get guidance in through the regulations or any other pronouncements by the service. Once we get additional guidance, we'll go ahead and share that with you. But yeah, at this point, it's a little bit open and there's a lot of interpretation. I've been talking to a couple clients, particularly in the software business, and it's, where they're using software as a service for different types of applications, but they designed the software. I mean, I don't think that would apply, but I guess you could make the argument on both sides. But that's an open area, and we're going to have to get some guidance. So I don't have the exact answer for that right now. Okay, so I'm going to go ahead and wrap up this webinar. Again, we really thank you for your time. We hope that you have enjoyed these webinars. As I mentioned earlier, it took a lot of effort for us to put these on. It was educational for us. We're all learning this new tax law at the same time. So it was educational for us. It was educational for our people. We hope you found them informative, and I'm sure there will be a lot of questions, and we look forward to your questions. So thanks again for being a part of this webinar series, and we look forward to talking to you soon.